Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin. It is about 15 minutes after 12 on Saturday, the 20th of August. And as you can see here from the chart of the S&P 500 that I have up, we had a down week, which was not the most interesting thing about the week. The interesting thing about the market action just in general is it's just very narrow. But this week's range did expand just a little bit, and if you'll notice, we actually expanded beyond last week's range on the high and the low side. Now, this is very unusual and can be bearish. It would have been more bearish had this been a solid candle, but you do have the range extending to a new high on the upside and then to a low below this low on the downside, and that's typically bearish. Now, I've been calling for a pullback here for the last, like 2 or 3 weeks, and really, what's been happening is the market's just kind of been following this trend line up. Now, last week it didn't resume. It didn't make it all the way to the trend line. You can see there's a little gap right here. So maybe we're finally going to get our pullback. I don't know. But again, if this was a solid candle, if this looked like, this from high to low, it would be pretty bearish. I would say it's mildly bearish right now. And given that we're expecting, a pullback, or I'm expecting a pullback, maybe it's a little bit more than bearish, or it's more than mildly bearish. Anyway, so what to expect? The market's been really tricky lately, and I don't know if most of you have been just on the sidelines or what, but this low right here continues to be very critical in telling us what this pattern actually is. I've got it kind of drawn like maybe it only comes down to here and then resumes, makes a new high up here, okay, which would be an ending diagonal type pattern. But it's possible that this is just the first leg of an ending diagonal pattern, in which case it's going to last much longer. The reason that's probably the reality, unless the market's topping right here and is going to roll over and break these lows. Ending diagonals are usually zigzag type patterns, so you get like I don't have the whole thing here, but you get like kind of an A, B. Well, I should have. Let me delete that one too. Where this whole thing is A, B, C, okay? And then you get an A, B, C, like it's there, and then an ABC up, and then another ABC down, and another ABC up. Now that could take, months. So I don't know. I'm not a big fan of that particular scenario, just because it's hard for me to believe that. I mean, anything's possible. It's hard for me to believe that it's going to take this long or that long for the market to correct. So I'm kind of leaning more towards, something like here and then back up to a new all-time high and then a pretty sharp collapse down to these lows back here in February. So we'll see. But this low will be the key. If this low gets taken out and then the market reverses up, then we know we got a much larger, longer-term pattern taking place here. Also, if you just look structurally, let me back out to like a 10-year. Let's see. Let me go back and leave it a little further, because what I'm going to do is I'm going to zoom in and I'm going to draw this. I'm going to draw on top of this space right here. But if you look at this structurally, you know, you can kind of see something like this. And right now, this is not as long as this down here. So the structure's a little bit off. Typically, this will be like, if this is 1, then this would be 0.618 of 1 or 1 to 1. So I could go back and measure this and then add it to the bottom here and see how much higher it could go. But the structure at this juncture is a little off. Now that doesn't mean it couldn't, roll over and go right there. I mean, it absolutely could. In fact, this is the support area that you would expect it to go to after it's through going up. In pretty short order, and I mean like in a couple of months, we're probably going to go to this once it tops. So, but the once it tops part is the part that we're kind of waiting on. So I don't know. There's a lot of risk in the market. We're going to look at the dollar, and we're going to look at the euro, and we're going to look at the VIX. In fact, let's look at the VIX right now. And I got to go out a little further. I'm going to go to a 10-year. But this line down here, way down here, let me zoom in so you can see it. This line right here, this is the 2007 low in the VIX. And you can see we're right there. So there's a tremendous amount of complacency in the market. Even though I hear there's some bearish talk too, but traders are not acting bearish. They're acting very complacent, as evidenced by the VIX. Now you got guys like George Soros with these huge put options on, trying to protect his portfolio if the market kind of crashes down. But right now he's losing money on those puts. So I don't know. This to me is one of the most scary things, because every time you get this kind of situation, it seems like real trouble's just around the corner. So keep that in mind as you're making your decisions around your 401k and what to do and when to do it and so on and so forth. Let's look at the 10-year yield and the 30-year yield, both of which our thesis is not panned out. So let's look at the 10-year first. We've been talking about this low right here for some time. This low right here from 2012. And then we talked about if this was the low and this was the first move off the bottom and then this was the first pullback, that the next move up could be very substantial. Well, that scenario is not played out. In fact, if you look over here, you can see that we have a new low. Now, what does that mean? Well, in short order, what it means is that first move off the bottom, pull back after the first move, that scenario is not in play. In fact, what we would be doing short term is we'd be looking for a close above this area right here. This high right here. So we get a close above this high, and then I would say a break above this trend line. Then you might be able to say that this is stopped going down for, say, the intermediate term. And then what you'd look for is a pullback like this, maybe back to the trend line, and then a big rally up. Okay, so, but the low was broken. The low was broken right here this week. This was the old low right there. You can see it was broken. Now we didn't close below it, which actually to me is bullish on yields. In other words, I would say, had we had a candle like this but white and it closed below it, then I would say there's more downside coming. But since you got kind of a spinning top or a doji here and just a long wick below the low, I would say this is a probable location for a top. Now there's a lot of talk about negative yields, and maybe they go negative, but I don't think so. I don't think that's going to happen in the U.S. Um, as big as the government talks here, it's not quite as big as the market, and I just don't see that happening. I could be wrong. I mean, wrong all the time. So uh, the key in being wrong is just admit it quickly and make an adjustment. So this is the 30-year Treasury, and likewise, you can see that we have new lows in the 30-year Treasury, and the old lows were right here. You can see we broke into this support box here, again with a longer wick. We're still needing a close above this area, so something here. And then I don't know, the trend line on this one is like this, so you would look for a break of trend, some sort of pullback, like so, and then take off. So um, if you're just now, tuning into the YouTube channel, I've been talking about losing money in bond funds for a long time, and actually have been wrong about that. And so, but let's just target in terms of odds favoring or probabilities. If I look at let's just say if I pull up all data on this, you can see that, well, that's not, let me look at the 10-year, see if there's more data. Yeah, let's look at the 10-year. So you can see that going back to 1981 was the high in yields. And if I had more data here, you would see that about every 40 years, you get a half cycle here. So, or about 30 years, I'm sorry. So 30 years from 1981 was 2011. So we're overdue. And it's probably been, a lot of it's been because of the QE intervention that the government has been involved with. But from an odds favor type of scenario, would you say it's more likely for rates to go higher here or for rates to go down even further? And I just say from an odds favoring standpoint, I would say the odds favor higher rates in this direction. Um, this is rates. This particular chart. This is not bonds. Bonds would be just the inverse of this. In fact, so rates, we're talking about rates doing that. So if you were looking at bonds, the bond fund would look pretty much like this. It would have a 1981 low here and it'd be traveling up like that. It's the inverse of that. Okay. Let's look at the 13-week Treasury. And on that one, let's just look at, let's go back to our 5-year and zoom in. And what you can see here, and I'm going to show you the dollar in a minute, but you can see here that, we did break this trend line. We didn't close below it, but we've got a couple of wicks, 3 wicks below it. And we're still inside this big bar. So technically, technically, we want to see a break above this area and then, a breakout of this line. And then we can say the Fed's likely to raise rates. You'll probably get a bounce back to the line and then movement away. So, and I'll talk about the dollar in a minute, but the dollar, the euro looks poised to start to go down. The dollar looks like it's poised to go up. If the dollar goes up and the euro goes down, it's very likely that you're going to see this take out and break out this level here. In fact, let's just go look at the dollar right now and the euro. Here's the dollar, and you can kind of see we broke out of this downtrending line here. We've been pulling back, and we've got a little kind of ABC pullback. We just need to see the dollar, we need to see a candle that looks like kind of like that, and then we can probably start to see the dollar move out. And if the dollar moves out like so, then likely what's going to happen is the euro is going to finally, let me extend this line a little bit. Whoops. There we go. So here's the euro. Zoom in on that. And we've been looking at this triangle. It's been chopping around. My drawing was all wrong. This didn't come down as low as I thought it would. But now we're at this trend line right here. And, you know, we're likely to see the euro follow through and go to new lows, break out of this triangle and go to new lows, which would take the euro down below this level here. So what is that? That's 1.0463. We could finally reach that parity that we've been looking for in the euro. And again, I think it just depends on whether or not if the dollar breaks out, the euro is probably going to break down. The 13-week Treasury is probably going to break out of that resistance area, and the Fed's probably going to raise rates. So that's a lot, going on, but that's, a likely scenario. Looks like oil is going to me, it looks like it wants to rally here to a high just above this high. But if the dollar shoots up, then we should get oil. We should see oil started to roll over and go down. Now, I don't know. The oil it could go up now, or you could get a pullback like into here, and then back up. But I think we're going to see oil ultimately get up here, maybe even close this gap right here. We got a gap on oil right here. Might close that gap and then roll over. But it looks like to me we're in a very large this whole thing was a 3 right here. 1, 2, 3, 4, 5. And it looks like to me we got to make a 4 here and then the last 5 down. Now, I think oil is going to at least go down to here, but you could see oil go all the way, back down to these $10 levels. I know it sounds crazy, but it's at least going to this 17.5 area. So look for that to happen over the next couple of years, probably. And we'll talk about nearer term targets so that we're not just focused on what's going to happen 2 years from now. But gold continues to chop around here. I think gold's just trying to kind of catch up to silver. Silver has a more distinct looking pattern. You can see it here. You can kind of see the ABC part right here. So I would look for both silver and gold to move to new highs over the next several weeks up into this area. Silver around, you got this old pivot right here, so you could probably take a decision point box off of that, and maybe silver even actually goes above 22, and then we get a pretty good pullback in silver. So if you're looking to buy physical gold or silver, you might want to wait a little bit until we get to these highs, because we could pull back all the way back into this $15, $16 area. In fact, it's likely that we will, and so that would be a better place to buy your physical gold and silver. Let's look at gold again. Again, gold is a more complicated looking pattern, but you do have these pivots here. There's a pivot right here around 1390. What is that? 1392.50. So, you could see maybe a logical place for this to stop running up would be an area off of this pivot right here. So right in that zone right there, which kind of is in line with what we see here. You might see gold pull back a little bit more, maybe make take out these older lows right here, and then rally back up into this area around that pivot. Let's see what that we already said that's 1392.50. Could go a little higher, maybe in here to this 14.15 area, and then roll back over and move all the way back down into this 11.90 area. So again, if you're thinking about buying gold or silver, you might want to wait a little bit. There's some crazy stock action in the market. There's a company, I'm not trading it, but this company, Asai, let me get off let's just look at a 2-year. You can see it back in July, it started to move out, and it's run from like $35 all the way up to over $100. Looks like maybe it could have one more high in here and then pull back sharply. It's gotten kind of, after this earnings report, it's gotten kind of what we call asymptote. It's kind of a ski slope kind of thing. And sometimes, depending on these companies and how good they are and stuff, but sometimes you'll get a ski slope on the other side too. So be careful if you're in some of these momentum stocks. A great way to look at this going back here is you can see, in fact, let me go back just a little bit further. But let's look at the daily. This is kind of a good way to think about trading if you don't have a good plan. But you can see here it pulled back into a low, okay? And then it ran up here. And then when it pulled back to a higher low. See, this low is higher than this low back here. And then once it broke this area right here, you could have entered this. Could have entered this stock, okay? So right in here somewhere, anywhere in here around the 13th of June or so. Now, it ran back a little further, right? And maybe you would have got stopped out, and maybe we'd have had to re-enter. But these are good type of rules to trade with. Wait till something takes off. Don't try to pick the bottom. Wait till you get a pullback to a higher low. Now in this case, it pulled back to a higher low, took off. It looked like it was going to take off here, but then pulled back again and actually made a lower low. So you would just simply, you would have gotten stopped out somewhere, I don't know where, depending on what your rules are, but you would have just got back in right here. That's if you like the stock and you like what they're doing and you like their earnings, all that other stuff is important to you. A lot of these companies that if you invest in individual issues, you want to see their earnings growing, you want to see their revenue growing, things like that for several quarters, so that you can kind of see that they're doing something. It's not just a flash in the pan kind of situation. Facebook still continues to do well. You can see here, had good earnings here, shot up, it's pulling back a little bit. Amazon continues to do well. So you've got a kind of a handful of companies that are doing well. I mean, Amazon still above this. I mean, if you draw a trend line here, I mean, there's just now kind of breaking the trend line. So you might, if you own Amazon, you might be a little bit cautious. Certainly, if Amazon breaks this previous low here, back here, then you probably want to be out of Amazon. So anyway, there's a few darlings left like that in the market, but a lot of the market is down. The financials don't look too good. Although they do look like they're breaking out of this trend line. Years ago, a guy that I learned from, he basically said that it's really hard for the market to do much of anything if the financials aren't participating. Now, maybe you can make an argument that they are here lately, but they're not at new highs. They're potentially retracing, a first move here, a first move down. So just keep an eye on that. I think probably the easiest thing to keep an eye on is the euro and the dollar. If you start to see that, let's go back to the euro real quick. If you start to see the euro roll over here, ideally what you'd want to see with the euro, because you got a pretty long candle here to deal with. Ideally what you would want to see with the euro is you'd want to see some sort of inside bar next week, something like, this, maybe a wick on it like that. And then the following week, you want to see, something like that. If you start to see that, then I think it's safe to say the euro is probably going to continue lower. And on the dollar, you look for a similar kind of situation. On the dollar, what you want to see is kind of an inside week, with maybe you've got some wicks on it. And then the following week, you want to see a full candle kind of take out this high right here. Takes out this high right here. This downtrend on the dollar is likely over, and we're probably likely to go new highs. Gold's likely to roll over. See, so, gold and silver look like they're going to make a new high. So I don't know. Maybe what happens on the dollar and the euro is you get kind of a fake out, right? You get a move up, but then you get another move down first. So we could have something like that, and then the dollar could break to new highs, gold and silver could break to new highs, and then the dollar rallies, okay? So you could have something like that. Anyway, I hope that's clear. I still think there's a lot of complacency as evidenced by the VIX. The VIX is at historic lows. I mean, when the VIX is low, it's time to go. That's the saying. So the VIX is definitely low. If you have a large portfolio with a lot of stuff, you might consider buying some put options on the SPY. See what those are going for right now. You could buy, if you're protecting a portfolio, you might go out to, I don't know, December and buy some out of the money puts, maybe around 210. You buy them for $447 each. That's $447 per 100 shares. So, it's pretty. It's kind of inexpensive, I guess. We'll see. We'll see what the market does. I mean, the main thing is you want to watch the S&P 500, but the S&P 500 really hasn't been moving much. So the dollar and the euro could give you some clues as to what the S&P 500 does. If the dollar goes up and the S&P 500, the euro goes down, the S&P 500 is likely to start going down. So keep an eye on that. All right, everybody. Well, that is it for this week's Middle Class Investor. Make sure you copy the YouTube link, send it to those you know. Also, I'm gonna start blogging. I don't know if anybody's interested in this or not, but I'm gonna have a blog on Middle Class Investor, and it's still under construction right now. But once I finish, I will post the link on the video here so people can see it. And if you're interested in anything I write about, you can go there. My writing is a little bit better than my speaking, I've been told. So maybe maybe it's a little bit better. Maybe it's easier to get somebody to read something that's written too, And I'll post some charts on there and talk about what I see. So also you can follow me, on Twitter at InvestorClass. That's @InvestorClass. And if you have any comments or questions, just you can email me at middleclassinvestor@gmail.com, or you can just comment here on the YouTube channel, and I'll answer those comments if they need answering. I mean, if they're just comments like "you're horrible, you don't know what you're talking about," then that's fine. I probably won't comment on those, but I will read them. So, all right, everybody, that's it for this week. We will see you next week. Take care and have a great and safe week. Bye bye, all.